Good morning and welcome to the Gold, Goats, and Guns Market Report for today, April 5th, 2023. My name is Tom Luongo and we have a lot to talk about. I want to welcome all the new patrons as always, and I don't know that I have any real housekeeping for this morning, to be honest. It's been kind of, well, quote unquote, quiet on my side of the world. So let's just get started this morning. I'm a little late getting this started. I usually have it out to you by 11 o'clock and I haven't even started recording until 10 after. So it'll be, you'll get it by about 1. Let's get started. All right. So as I was, I don't know if you guys know this, but when I put the market report together, I do all the slides first because it's mostly kind of rote. I'm going to do, it's the way of waking up in the morning, and by the time that first couple of cups of coffee kick in, I'm now, capable of doing something close to analysis on what's happening while I put together the gold chart and all the rest of them. So I don't do, this is the last slide I ever produce. I always come back to this last. So this is actually, sometimes it's actually even the hardest part, because at that point then I have to start reviewing the headlines for the morning, and I get my head out of what I'm seeing in the markets, and I have to actually, relate all this stuff to what's going on in the markets. So, as much as Zero Hedge has been ticking me off recently, they're still an excellent source for headlines, even if I don't agree with, half of them, which is fine. It's the way it should be. So I saw this note this morning about FedEx and layoffs, and I found it really interesting. It was a short little post. I think it was just a repost of a Reuters article. Nothing. Matter of fact, there's a bunch of stuff this morning that came from, I think, Reuters and or Bloomberg. Via various sources that were very interesting. FedEx is restructuring its entire internal logistics, cutting 10% of its staff, looking at something like $4 to $5 billion worth of operational efficiencies a year going forward, and they up their dividend at the same time. Now, the sad truth of the matter is that you will hear now, again, the Elizabeth Warrens of the world. Like I said the other day, if you're sick of Elizabeth Warren now, just wait. We'll be complaining about, corporate America is screwing labor because, there's no need for these people and blah, 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 and what are they going to do? And, well, yeah, that's the nature of things. I'm not a huge fan of Schumpeter, but, his creative destruction part of the quote-unquote capitalist or free market economy is the way of things. You have to evolve or you die. It's just the way of the world. And, this idea that everybody's owed a job or everybody's owed a living is so basic, so bound tightly within the Marxist framework, and it's quite dangerous. So you're going to hear this refrain over and over and over again going forward. The layoff cycle has begun, but it started months ago, seriously, and for it to get to and to now reach FedEx like this is telling. Look, even with oil prices coming back down into something approaching rationality, given the level of inflation and everything else, the amount of inflation, the absolute value of the CPI, not the year-over-year change of the CPI. When you think about it in those terms, FedEx has got to find efficiencies where they can, and even with oil prices coming back down, shipping prices are starting to fall. Logistics doesn't look as good an investment as it did, say, a year ago. That's not to say that I think logistics is a bad investment. I just think that it was definitely went through a short boom, and it's going through a short kind of boom and bust cycle. And I think we're going to be near the bottom of the bust cycle here, because what you're going to find next is that transport and shipping and logistics have to get better. And they have to get better because zero-bound money has gone away. You can support these unbelievable supply chains global supply chains when money is free. And relative to the profit margins, energy input costs, can be effectively hidden within other parts of the balance sheet, i.e. investments and all the rest of it. Like, you can do this because, your currency hedging and all the rest of those strategies, when money is free, there's all sorts of ways to mitigate your COGS, your cost of goods sold, your all-in sustaining cash cost, if you were talking in terms of like a gold miner. When money is not free and the credit cycle is we're on the backside of the credit cycle and credit's contracting, this is when we find out, where the operational efficiencies are in all of these companies and in our governments and everything else. And so what's going to be lost in all the commentary coming into the presidential election cycle is the following. They're going to blame the Fed for raising interest rates. They're going to blame, your layoff on Jerome Powell because they want to go back to the zero bound so desperately that they'll say or do anything to get there. When the reality is that the people who are not being laid off are in government. So the private sector gets leaner. Margins are compressed. COGS rise. And the tax burden on the consumer and the producers also rises as a percentage of profit radically during recessions. And this is when government needs to take a haircut. This is when government needs to contract. If FedEx is going to contract by 10%, then government needs to contract by 10%. And you'll never hear this out of Washington. You'll never hear this out of Brussels. Keynesian economics, whether Keynes believed in all of this nefarious shit or not, is up for discussion, right? I happen to think that Keynes is, fascist, but, we can argue about that. And I'd be happy to have a rational argument about Keynes's, politics as it affected his economic theory, his general theory. But the one thing you cannot argue about Keynes is how it's been used by those who seek power to justify an ever-expanding state with the goal of creating a transnationalist, globalist, new form of digital feudalism. This was always their plan. Philip K. Dick snuffed this shit out back in the late 50s, for Christ's sake. Okay? To a lesser extent, so did Asimov. So, the science fiction writers of that time, they understood this stuff. By the way, if you guys don't believe in any way that I have any of these ideas, these market reports planned out, I had no idea where I was going this morning when I put the FedEx picture up here. But this is what happens in real time. So when you think of it in those terms, right, the Marxists continuously use use bad economic arguments to pull on your heartstrings to get to a particular desired result, where eventually they will control all of the productive capacity and of a particular society. And they have that mostly locked down in Europe until the people start lopping off the heads of local leaders. But there comes a point where everybody has to take a step back and go, what do we get for all of these services that we're supposed to be paying our quote-unquote fair share for? I mean, what do we get? Now they're telling us they don't even want to police the streets because police are racist. Now they don't want us to do any of these. They don't even want that. Now they don't even want to provide the basic services that they used to tell us was a cost of doing business in order to have civilization. This is what conservatives tell me all the time. This is what liberals tell me all the time. And as a libertarian, I just sit back and I listen to them. I go, that's nice. You're talking your book. I'm like, but that's not the way the world's actually working. Like, we don't need to spend 65% of our productive capacity on providing these quote unquote meager services. The legal system is priced out of most people's reach. We can't get, I mean, I can tell you, like, it's listening to the commies that run Alachua County, they forcibly charge rural folk in Alachua County to pave their road. If one person or two people on a particular, dirt road who have money lobby the county to get the road paved, the county road paved, they then assess a lot charge to everybody on top, as a special assessment on their tax bill, which, by the way, they already pay the highest tax rates in the state for no services, so that, the city of Gainesville can, have universal health care for indigents. Okay? Which, by the way, is also another special taxing district that they put in place 20 years ago, and it's never gone away. And so the poor people down the lane get screwed. The county wants to do this because they want to pave the road so that they can, get around the homestead exemption to raise everybody's property taxes because of an improvement, and then price, the poor people out of their homes. This is government at work. This is the way this works. But, if we weren't paying so much money into this maw that picks winners and losers and only thinks in terms of how it can, like anything else, grab market share for itself, it's just like any other organization. It's like any other corporation. Governments are just, grabbing market share just like everybody else is. Except they have the gun. And the only companies that are going to be allowed to survive in this particular environment are the ones who ally with the guy with the gun. And you're going to hear, price gouging and anti-labor stuff coming out of President Yellen, out of Elizabeth Warren, out of all these people. And Warren's clearly setting herself up for a run for president again. But she's already been told she's not going to be president. Her job is to set up whoever is going to be president and to shift the narrative. It's her job. She knows that job, and she does it very, very well. But that's the problem with all this, right? Because in their mad quest to gain market share over the economy that they believe should be fully within the purview of the state, what are they doing? They're bankrupting the very people and the very system that they say they're fighting. The people who they need to have enough money and enough capital, real wealth, to fight those that they tell us are the real commies, the Russians, the Chinese, the Iranians, etc., the real authoritarians. When the reality is that most of those societies are post-autocracy. Maybe Iran isn't, but we can argue that Iran is certainly trending towards being post-autocratic, whereas China is kind of autocratic. Russia is definitely post-autocratic. It's in the awkward stages of becoming post-autocratic, trying to figure out how to make it work. So when you start to think about all of those things, and then you think about what's happening in the oil markets, it's pretty clear that the trends that are in place are not going to stop anytime soon, because the cultural imperatives and the cultural programming that exists within the minds of each of the sides of this divide, if you just break it down along the international north-south transport corridor, as I've talked about previously, it's pretty obvious that oil is going to be the dividing line. So I see this morning from, on the Slack server, somebody posted an article on Reuters that Russia is moving its oil trading, Rosneft is moving its oil trading out of the West and into Dubai. It's going to put its oil tenders up for sale on the Dubai Oil Futures Exchange, along with gold in Dubai. The Russians, one of the largest producers and exporters of oil in the world, will now, and one of their major companies, will now be listing their oil futures, their oils for sale, outside of the purview of the West. What this does is it delegitimizes Brent that much further while improving the liquidity of the Dubai futures contract. And I've said this many, many times. Where liquidity goes, again, if you're confused about what I'm about to talk about, Vince Lanci and I went over this in grave detail in the podcast we did 6 weeks ago. And so I absolutely recommend everybody listen to that again and understand that this is two Italians, free associating in real time. So it may be a little hard to listen to, but understand with this background that the markets that are getting more liquid are getting more validated, becoming more valid. And the ones that are losing liquidity are the ones that are becoming less valid. So what have I been complaining about for months now? And I wrote about this the other day in the Morning Munchings, that the oil markets in the West are becoming less and less and less liquid. The volatility washing that's been going on the Brent futures contract on ICE in Atlanta and in other places, the Brent contract and WTI and all the rest of it, the washing out of the small speculators and through high volatility in oil has made those contracts untradeable. And they did that so that they can control the price of oil and then send it where it needed to go. And when they had full control over the pricing of oil, because 99% of oil futures were handled in either Brent or WTI, and the oil was quoted as a premium or a discount to Brent, then the Brent futures contract, again, like I've talked about with Eurodollar futures or gold futures, is the tail wagging the dog. And the consumers have, and don't get me wrong, consumers should have ultimate control over the marginal pricing, the marginal unit of production's price. But when we're talking about people who are not consumers of the product, they're just speculating on what the consumers are willing to pay, then the speculators become the focus of the market. And they become the price setters. Well, what if they've got so much money because of zero bound interest rates that they can overwhelm both producers and consumers' interests in these markets? Well, then you have what we've had for the last 15 years. FedEx should be a bigger effector of the price of oil, effector of the marginal price for oil and diesel fuel and jet fuel and everything else, than George Soros, as an example of a large spec playing the market and trying to push the price in a particular direction. Up when it suits his agenda, down when it suits his agenda. Right? FedEx should be a price maker, not a price taker. They're a consumer. Russia should be the price taker. But this imbalance between producers and consumers is so high because of the speculators in these markets that now the producers have to come back and go, you know what? No, I have pricing leverage. This has been a theme of my writing for the last 3 or 4 years. It's just I'm getting better at communicating this stuff. So watch the Brent futures. At some point I'm gonna have to turn around and stop using Brent. I'm going to have to go, get quotes in other oil contracts and then start looking at those spreads. I'm old enough to remember when Brent wasn't the dominant quoted price for oil. It was WTI, it was West Texas Intermediate, and everything was, priced as a premium or discount to West Texas Intermediate. And it shifted to Brent. It's now going to shift somewhere else. And it's very important. So, with that said, let's get to the charts. Gold. Boom, baby, boom. The Monday jobs report and the response to it, frankly, way overdone. But, again, these markets don't know what to do. They don't know how to react to incoming data because they've been now drained of their liquidity to the point where they can, when I'm seeing 20 and 30 basis point moves in the dollar futures markets, even Jeff Snyder is actually admitting to reality that these markets don't make any sense. He's never seen anything like this. Yeah, exactly, Jeff, which is why you should really update your model as to whether or not, these markets are predictive or responsive. They were predictive when money was cheap, and money was always progressively getting cheaper because that was the goal of the agenda of the people who created these markets in the first place. But what happens when there's a shift and somebody says, you know what, no. What happens when the Fed stops getting in the way of a rising gold price? What happens when Russia and China say, you know what, we're done accumulating, we're done accumulating at ultra cheap prices? You start to see a chart like this. I'm having a hard time not looking at this chart and not going, this is interesting. False move down. This was an avoided. This is your reversal signal, 4-week downtrend, and then boom, a 1-bar engulfing bullish reversal. Engulfing because it broke both previous high and previous low. Reversal signal because you closed above the last high in the downtrend, and no reversal signal here. Just a big boner move up, blowing away horizontal resistance, then holding that area on lowering volatility. This little flag pattern here, I'm not a huge fan of these, but it is important to understand. Look, volatility dropped week over week until this week, and then boom, gold breaks out on Monday on the jobs report because the market is overreacting to the idea that the dollar needs to go lower. A lot of shenanigans going on in the markets in terms of trying to push the dollar lower. And if you really want to understand how these things are all connected, think about the Trump indictment. Again, when they want to create uncertainty in the U.S. financial markets, they also go out of their way to create maximal uncertainty in the U.S. political system. These events are not out of phase with one another. They are intimately linked. When you have capital markets that respond to headlines. I was chatting with Marty Bent last night. The podcast will come out on Friday, Marty, on a couple of days, Marty told me. We chatted last night for about an hour and a half. And, and we were talking about this very thing. And, oh God, what was I trying to say? I hate it when I lose my train of thought. I'm very sorry. But, these moments in time are inextricably linked, right? The political unrest and the financial market and where they want the financial markets to go and trying to these things are inextricably linked. And I made this point to Marty Bent the other last night. And, we have to start thinking about, what that's going to mean going forward. So, when you want to, you're doing that for the purpose of trying to freeze capital in place. And the Trump indictment is a perfect example of that. Like, they held it off for a couple of weeks until, as Robert Barnes pointed out, one of the most cogent things Barnes has said in recent weeks that, they, look who else they, indicted on, they arrested the week of, in early April. Clearly, alluding to the upcoming Easter, right? The Easter holiday. So the symbolism's not lost on them. The timing is not lost on them. They know exactly what they're doing. And so it's really important to tie these things together, because this is how they can get maximal effect and also rub our nose in it. But it doesn't mean that they're going to win. It just means that they can't help themselves. Gold, if gold closes this week above $2,000, and be honest with you, up in this 2030 area, and again, this is cash basis gold, not what you're seeing on the futures market, which has been trading now with an almost $18 to $20 premium. When the cash versus futures premium is that big, it's usually indicative of probably coming into a high. I'll be honest with you. I don't think gold is going to close at an all-time high. I think it may create a new all-time high coming into the next couple days. But I think we'll get a double top or a triple top in gold here, going back on the weekly chart. That's what I think is going to happen. And then that's going to back off. But then again, the Russians and the Chinese may just come into the market and go, you know what? No, we're going higher. Hey, we're going higher. Now, does the Fed want a higher price of gold? Probably not. But, again, if you're trying to create this idea that, the United States is on the verge of collapse, this clown world perception, well, indicting Donald Trump the week of Easter, it's a pretty big move. And they're doing it at a time when they're trying to pull our eyes away from the what's actually going on behind the scenes in the rest of the capital markets. Europe was in focus for a couple of days, and all of a sudden they were arraigning Trump. Everybody, Deutsche Bank was on everybody's lips a week ago, and now all of a sudden all they can talk about is Trump. These are, these things are not unlinked. But let's watch gold here. Let's see if gold can push through to a new high and close at a new high. If it does so, that'd be a big deal. It would mean that as we come into, this period of time, gold could do something weird. Gold could spike here as opposed to create a double top and then sell off. So let's see what happens. So with that said, I was asked by a patron to do a quarterly chart of the Canadian dollar the way I did the quarterly chart of the euro in the last market report from Sunday. And I started doing that, and I said, that's not really what I want to do this morning. I was looking through my list of old spreadsheets, and could I update the data set, and blah, 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 blah. And I went, no, doing gold across the currencies, I think, is a better discussion for today. I don't know that, the Canadian dollar is all that important in the long run to do a big historical review of versus the euro, because the Canadian dollar is not in... it's not in opposition to the U.S. dollar. The euro is. And so that fight is kind of important. So while an interesting thought, given all that I have to cover, I'm not sure that, putting together the quarterly chart of the Canadian dollar is something that, and looking at it over a 15-year history, I don't know that, unless I want to write an article about it, but I don't think I'm going to do it. I think it's better to look here at gold in multiple currencies, or at least in multiple across versus different assets. So we already talked about the Q1 close, and now it was the highest quarterly close of all time, right? And how we have a double top here, which also generated at the time in 2020 and 2021 the highest quarterly closes of all time. and yet they were still able to smash it down, creating a 1-bar reversal here and a 2-bar reversal here. This is clearly a false move down. We have a 2-bar reversal of this weak uptrend because we never closed above this high. Note these 3 highs here. Note the highest close. Easily sets up a 2-bar reversal back into the 1600s, which is clearly a false move down, because then we get the 1-bar reversal here and then follow through in Q4, the Q1, and now Q2. Right? And we've already broken last quarter's high. And this is in US dollar terms. So this is clearly a false move down. Okay? Now let's look at it in euro. But notice the big, long, this is what looks like a classic kind of cup and handle, except this was a cup and handle that then created a false move down, which is now going to create the actual breakout. But if we get a triple top here, gold could hold this area for a while in dollar terms. Meaning, if gold does this, if gold doesn't break to a new high, you can bet dollar weakness is also overdone. So let's watch the 2100 area very carefully. Because now look at the euro. Notice how gold bottoms in 2015 and then meanders around for 3 years and then goes on a 4-year bull run. In euro terms, it bottomed in 2013. Meandered around, built a new base, broke out, weak 3-bar reversal, and then a new one, and then, so it's basically up, sideways, up, saunters vaguely downward, and then blows out at around the same time that it does in the dollar. So these are secular bull moves, but in the euro. But in dollar terms, it's not quite a real breakout, because we haven't bested the all-time high from 2020, whereas in euro terms, we clearly have. The false move down in gold was back in 2020 on the euro. Up, down, correction, boom, breakout. I mean, even the 3-bar reversal here. Again, 3-bar reversals aren't really reversals. It took 3 bars to get the reversal signal. That doesn't mean it's a strong signal. It's actually a very weak signal, which then, of course, set up this high here. So now we're looking at potential triple top in the dollar and a double top in the euro. Now let's look at the Canadian dollar. Why the Canadian dollar? Well, mostly for the patron who asked about the Canadian dollar, and also because the Canadian dollar is a good commodity currency. Whereas the US dollar is the reserve currency, the euro is I don't know, the pretender to the throne, and then net energy consumer, net energy producer. And then notice, again, a similar pattern, except with an upward bias because of the bear market in oil in 2014 through 2016, right? Which was engineered in order to create turmoil, political turmoil in Russia. It didn't work. Didn't break, basically a long, upwardly sloping, upwardly biased consolidation between 2011 and 2019. Then the breakout, again, in 2019 or late 2018, boom, into the top. And now, but notice what's happening here. We finally get a new all-time quarterly close. This whole area from 2019 forward is a quarterly close. This is how much weaker the Canadian dollar is. And part of that is because of the low price to oil, the low price of oil. And then let's do the math and let's look at gold in terms of barrels of Brent crude. How many barrels of Brent crude can you buy with an ounce of gold? That's what this chart's telling you. This is a remarkably flat chart. Here's the financial crisis in the beginning of QE. And then they fuck with the price of oil. And then, cure for low oil prices is low oil prices. And then the cure for high oil prices is high oil prices. And as oil prices have collapsed, gold has moved higher. Now, this is in US dollars. But what's important to understand here is that nothing tells you the value of gold as a protection, as a protective asset of your purchasing power than the gold to oil ratio. It bothers me sometimes to listen to Martin Armstrong bash gold as just another trade, because he can't help himself, because he, is so desperate to break the gold bug's religious fervor over gold. In the same way and honestly, I was talking to Marty Ben about this yesterday, about the Bitcoin maxis, religious fervor over Bitcoin. And I was very generous. I said, look, I get it. In a world as fake as this one, having a bearer asset like Bitcoin that you can, latch onto and, and dispense and destroy all the narratives and all the control and all the tyranny and all the rest of it. I get it. It's very attractive. It doesn't necessarily mean that it's going to happen in any time frame that's actionable for you. That's all Marty's really saying about gold bugs. Remember, he used to be the largest precious metals dealer in the United States, and only became the Martin Armstrong we know and love, or sometimes love to hate, because he was the guy making a market in gold, and effectively was the futures market in gold for a while, and was there at the beginning of trying to coordinate price and time in gold. So his perspective on this is not, without merit. He just takes it too far. And that's fine. It is what it is. There's a little bit of ego here. I get it. I'm not, not gonna be angry about it. But when you look at gold and you price other commodities in gold, especially those that make up what's known as core inflation or headline inflation, and the stuff that they try to strip out to make it, make the headline number look better than it is. This is the gold goats and guns ethos writ large. Preserve your purchasing power and accumulate real assets. I've put up the gold to silver ratio chart in the past. I haven't done this kind of analysis in a while. This is important. It was plainly obvious back in 2020 that oil was criminally undervalued, and anybody who went long oil off the COVID collapse in the price of oil made a killing. Imagine buying oil at 62 ounces to the barrel. Imagine that. Your goal isn't to make dollars. Your goal is to make assets. So, imagine having bought. So you use this to your advantage, because they will always engineer some freaking crisis for political purposes. But the market eventually will win out. There is no trend here. And if there is, it's a vaguely weak uptrend. And here it is. But really, it's just a new trading range between 15 and 30 ounces per barrel. This is also the best chart in the world to dispel all the Malthusian bullshit of Steve St. Angelo and Chris Martenson and all the rest of the friggin' peak oil assholes. Stop listening to them. I'm dead serious. Challenge them at every level. Put this chart in front of you. You have my permission to put this chart. You know how I produced this chart? All I did was go to investing.com, go grab the monthly closing price of gold and the monthly closing price of oil for the last 15 years, put it into Excel, and plotted a line chart. And go, here you go. Show me where energy returned over energy invested is rising at some exponential rate. Inflation adjusts both numbers and then tell me what's going on. You'll see an even like more compressed chart. It's even worse. They're just, I hate to say this, they're just grifters. And even if they're not grifters, I've talked to Steve St. Angelo. He literally told me that if you believe in the law of diminishing marginal utility, you're a moron. You don't understand the world. I'm like, really? Okay. You don't understand EROEI. I'm like, oh, I understand it. I just happen to believe that technology is, and human innovation is bigger than some, is more powerful than some dumb statistic that, some Chicken Little with a crappy website, makes his living off of. Like, that's it. It's that simple. Sorry, and I know that there are people here who are who are somewhat peak oil people. But if I can do nothing else than to disabuse you of the notion that Malthus is always wrong, that Malthusian thinking is always wrong. And if I have to beat it over your head like Martin Armstrong beats it over the head of fucking gold bugs, I will. This is a more important argument than Bitcoin maximalism, being a gold bug, or anything else. Don't be Malthusian. Don't be linear in your thinking. Don't see a short-term trend and then push the slider to the right on Excel and, linearly project. Don't take a short-term thing and then project out your short-term correlation to, an extra 18 or 20 periods. You can do that, by the way, with a linear least squares regression of a data set. You can project linearly out into the future. You can do that. You should do it. And then you should trade against it, and then you should, and then you'll come back to me after you've lost all your money. I mean, sometimes I have to give it to you straight, dirty, and blunt. But if these 4 charts don't tell you a particular story, after all of this, I'm not going to be able to help you. But I don't think that's really the case. I think most of you get it. Most all of you get it. And if you don't get it, that's great. And if you're here to learn, that's even better. This is important. This is the core of everything we do. Long story short, TLDR, it's almost never a bad idea to buy gold. Just don't do so when it's expensive. Learn to read the charts, learn to find out when you're getting a bargain, and then buy some. FYI, I bought gold down in here. Okay? I didn't buy a lot. I bought some. I added to my stash. I added to my stash here. I added to my stash here, and I certainly added to my stash here. And this is when I was, yeah. Okay. Use this stuff to your advantage, and you will make money. And for the foreigners for the non-Americans, sorry, I hate to use the word foreigners. It sounds vaguely derogatory. I don't mean it that way. For the non-Americans in the audience, chart gold in your own currency. And you can do this at investing.com by putting XAU/ the three-letter symbol for your currency. SGD for the Singapore dollar, NOK for the Norwegian krona, HKD for the Hong Kong dollar. Pick a currency, okay? And you can do this. Now you don't even need to build. You'll have to building the quarterly chart will be difficult, but you can get the monthly data directly from investing.com. You can get a monthly chart off the top of your head. It's easy. I like the quarterly charts because it really gives you a nice way of building the long-term trend. But building quarterly charts is a little difficult because you've got to aggregate 3 months worth of data because you'll never get quarterly data directly. Okay, so and there's a couple of tricks in Excel on how to do this in order to clean up the data set quickly and do it. I know how to do it. I've been doing it for years. That's why I love doing the quarterly charts. And once you can do quarterly charts, you can also do annual charts that way as well. But I'm not going to give I'm already way off topic, and I got a lot more to do, and I'm not going to like give an Excel lesson right now. But we can talk about it. It's not particularly difficult. All right. Silver. There's the weekly chart in silver. Look at what we saw. What did we say the other day? Right? Hey man, silver's coming up into this big, ugly horizontal resistance in this 24-25 area. Oops. We hit a high above 25. We're trading near 25 today. This is good. This is excellent. This is beautiful. Again, if you look at this on the monthly and quarterly chart, clearly a false move down. We got the market way on the wrong side of the trade, and now look at all of the fuel as the shorts have to cover. Had you bought a bunch of silver in the $20 area, you'd be up 25% on your money. You'd be up $5 on 20, right? Good deal. So was I in there telling you to buy our silver stocks then? Yes, I was. Also telling you that it could break to 18 or even 17.50, depending on how the things went. Oh well, we were right. Industrial metals are setting up nicely. Bitcoin. I like what I'm seeing in Bitcoin. We moved up. Going back, here's the big bar that, where the breakdown occurred. But the reality is that there's horizontal resistance not shown on this chart in the 28,000 area. So this is going to be difficult. Like the 2,000 area in gold and the what should have been the $24 area, 24 and a quarter area on the silver chart. Wait till silver gets to 26. Then things get really interesting. This 28,000 area is important for Bitcoin because once it gets back into the 30s, we now get back up into the previous trading range before this breakdown, which is Terra Luna. Collapse of Terra Luna. Collapse of FTX. No more collapses. And look at what Bitcoin's doing. It's very impressive. Volatility is starting to rise again because there is no liquidity. Because the exchanges have been drained of all of their false liquidity, their magic beans. There's no volatility, and now it's not volatility watching. Now the volatility watching happens on the bullish side, not on the bearish side. And again, once you wring out all the excessive leverage out of the Bitcoin market, now we can find out what Bitcoin's really worth when it's only trading against something that is 100% backed by the US dollar, which is, in this case, in my suspicion is that Tether is that. And I think Tether is owned by the Fed. I brought this up to Marty as well the other day, last night. And he was just like, he was flabbergasted. I'm like, think about it. You need to keep some liquidity in Bitcoin. You should only have one stable coin to do that with. And it should be under your control, not foreign control. My argument is that the Fed owns Tether now, or the New York banks. Brent crude. Okay, so one of the first things to talk about one of the first things you learn in chart analysis is that gaps are always filled. So the timing on what OPEC came up with, on Sunday to force Davos into retreat, this gap's going to get filled. We're going to get a retest of $80 or $78. And then we're going to find out but will we get that before we get a break above the top of the trading range here? That's a good question. So far this week, no. But let's see what happens. Okay, the trading, we opened at $84 and we hit a high of nearly 86, and it's trading incredibly low volatility. Somebody is sitting on the price of oil here and trying desperately to keep it from moving higher. And it ain't the Russians and it ain't the Saudis. Who do you think is sitting on this? You know who's sitting on this. The Chinese don't care. They're buying energy from the Russians at a discount. The Indians don't care. They're buying energy from the Russians at a discount. Europe cares. Europe is in trouble. And so there's a whole lot of washing of other markets in order to find the liquidity to keep the price of Brent under $90 a barrel here. This Brent should be trading at $90 a barrel. The fact that it's not is telling me that somebody's sitting on the price of oil, desperate to hold on to the price cap, the this, the that, all of this stuff. Because at 85, all of a sudden, Japan is buying Russian oil above the price cap. And that made big news. And I'm sure Janet Yellen was angry about this. I mean, President Yellen. So, I mean, I think oil goes back above 90. But I'm going to let the market tell me. And if they can defend this $85 area, I mean, they could defend 90, honestly, and force a gap refill. What do you think is going to happen with these, with this production supply and demand mismatch? That's now almost 3 million barrels or 2 million barrels a day. Do you really think oil is going to stay at $80 a barrel? No, it's not. Not unless you can engineer a worse financial crisis. And how are you going to do that and keep the dollar under pressure like they've been in order to minimize the price of oil in euro terms, right? By pushing the euro back towards $1.10, which is what they've done, right? In order to minimize the current account effects on the Eurozone. This is a big deal, guys. It's all coming together. So, mind the gap in oil. Patreon request. I forgot to animate this chart, I'm sorry. But let's do it real quick. Hess is an oil company. I'm sure that when I got this request a couple of weeks ago, it was because of this, because it was trading down in here. So, and I didn't want to touch it then because what would be the point? One, I had already done a couple of other oil companies since then, so whatever analysis I did on those companies would clearly be analogous to what you'd see in Hess. But now that we've seen oil recover a little bit, what do we get? Well, Hess dropped down into this area here, which is relatively strong support. There's a whole lot of, relatively speaking. Remember, look, I've complained about the volatility in oil. Well, here it is writ large in Hess's chart, as opposed to these smaller bars. Look at these big bars, like just the size of the bars. That's telling you there's greater volatility. So, the big thing here is that you had an uptrend and then some consolidation and then a blow off top. And then did we ever close below the low of this last up bar? No, because technically this would all be one big uptrend. Noisy and ugly, or here's the uptrend starting here, we up. No reversal signal, so this reversal is still valid, so the uptrend is still valid. We up, down, reversal avoided, another push higher, trade a couple months up higher, blow off top. Did we get with the March close, did we get the reversal signal that clearly was in the offing up until the last couple days of the quarter? Nope. And we're back up here. So we avoided the reversal signal in March. You need $142, which is basically this high right here, plus or minus. You can go look it up, whatever the March high was. You need to close above the March high, which is roughly $142 a share, to resume the uptrend. This is an oil company, so watching the price of oil, kind of important. Now, so it's an oil company. Hess has a lot of debt. It has a lot of debt relative to the sector, which is why probably we're dealing with this kind of volatility. Which is also why, since the debt is high and debt servicing costs are high and cash flow is kind of low, we have a low yield. For an oil major to be only returning 1.8% in this market is actually not particularly great. That said, the company's also repairing its balance sheet because equity has been rising nicely, even though oil prices have been dropping over the last the last 2 quarters, or last year, 4 quarters. So we have shareholder equity rising with low cash flow and debt being dogged because of its high debt. So this is a company that don't expect to have a whole lot of leverage relative to a rising oil price until we get above $100 a barrel. If Hess, through time, continues to pay down its debt, improve its balance sheet, then an improved balance sheet will flow through through all of its financials, and the yield will start rising, and cash flow will increase. And it's effectively all-in sustaining cash costs won't be $80 a barrel. They'll drop into the 60s or the 50s. I don't know the company beyond that. So that's for you to do your due diligence on the quality of its assets and all the rest of it. Block Corp, which is effectively Square. Payments, digital payments, all that. Collapse. Back to, froth off the market. Oh, look, zero bound money, gone. The big thing here is number one, the breakout in December, followed by avoiding a 2-bar reversal in February. March, not really interesting. Now opening up in April, sauntering vaguely downward, violated this low, but never closed below it. The balance sheet is in excellent shape. The low debt to equity ratio. Equity is rising, also very strong. Cash flow, however, topped in 2021, kind of expected. Needs a move above $70. If it gets a move above $70 in this market, I think you'll start to see some short covering. But this was clearly a premature breakout. They set up on it looked like about $85, maybe $88, and then shorted it back into the 60s. While I was getting set up to do today's report, we were talking about on the Slack server, somebody was talking about asking me to do a chart of UUP, which is the U.S. dollar ETF, and stocks like UUP or funds like UUP or USO, the oil market, and really even EUO, which is the ultra short euro. These are vehicles for playing options, for retail investors to play options on movements in the dollar, oil, the euro, and whatnot. You don't buy UUP. You buy options on UUP because if the currency moves 10%, with 2% brokers fees on either side, what are you making? 6% on the trade? It's not even worth, other than like bragging rights. I made a good call on going along the dollar. You use the dollar, you use the option movement in the options markets in order to make money in these. And if you go look at the option chains, you'll see they're very liquid. Open interest, 35, 40, 50,000 contracts, maybe even more. I haven't looked at the option chain of UUP in forever. But UUP is really just a proxy for the US dollar index. So for those guys that asked for that, okay, let's put up the USDX monthly chart and let's talk about it. And then we can talk obliquely about the stuff I normally talk about on the slide. Here's the big one. 2-bar reversal a few months ago. 1-bar reversal, and then March, a collapse. We had a high probability setup of a 2-bar reversal to negate this downtrend, and it failed. So we're back down to here, and now, someone clearly wants the dollar to fall, or needs the dollar to fall. What's happening here is that we're seeing a massive run in treasuries. People don't need dollars, they need collateral. They need collateral because the banks are in trouble. And the European banks are the ones that are in trouble. Martin Armstrong in a private blog post, and I brought this up with Marty Bent last night, so, Martin Armstrong brought up, and I think in a private blog post, that the Fed's FEMA, F-I-M-A, not F-E-M-A like FEMA, but F-I-M-A or FIMA facility, which is basically the Fed foreign repo facility, which they opened up at the July meeting in 2021. And I've talked about obliquely, not nearly as much as the June 2021 reverse repo 5 basis point move, which was again, it's like everything else. You kind of have to be careful, what you dump on people. So let's get to so when I shaped a lot of the narrative on this, I was like, look, let's talk about June 2021. Let's talk about the significance of that. But the next meeting at the end of July was also important. And I have talked about this. I talked about it with Daniel DiMartino Booth, who nodded her head vigorously when I mentioned this, which is that the reverse repo facility is a big pile of cash, and the foreign repo facility is the means by which to control the flow of treasuries. And since the American banking system won't accept the European sovereign debt as collateral for repo contracts. The Fed had to do so. That means that they had to go, the foreign banks had to go, and the foreign central banks had to go to the Fed to get collateral, banking collateral. This is important. That means that they effectively shifted monetary policy away from the normal repo window and the discount window to the reverse repo facility and FIMA, which is, again, another one of these arguments that I've made in the past. So knowing that, and knowing that FIMA was hit up during the Credit Suisse Silicon Valley Bank debacle for $60 billion worth of collateral, when even during COVID, we only saw 1.4 billion used. The aftermath of COVID should tell you everything you need to know about what's going on in the European capital markets. They are massively short collateral. They had to go to the Fed to get it, and they didn't pay zero bound interest rates to get that collateral. They're paying freaking the Fed funds on that. And that's why it was part of Marty's argument as to why there's been such a move in the long end of the yield curve to get high quality collateral. They just started buying the entire yield curve, 2, 3, 5, 10, 20, 30. That's why the 210 spread has collapsed back to 60 basis points from 100. The negative 60 basis points. So the 210 inversion has moved back. So because of this, that's why we're seeing such a massive run into U.S. Treasuries. It's also why we're seeing a collapse of U.S. German credit spreads, exactly as I would predict under these circumstances. It's threatening the February low at 1.12%. I actually saw a print intraday below 1.1%, like 1.08. And then Lagarde, right before the freaking European close this morning, pushed the spread 4 points in the other direction. Almost positive it was her. Has to be. This number on copper is wrong. It's copper's trading about 398, not 408. But everything else is correct. There hasn't been much of a move in any of these currencies other than the euro is up and the pound is up, again, because there's a need to get collateral, to collateralize trades, and people are trying to, the banks are trying to get collateral, the people are trying to get cash. Yeah. And they're selling the dollar to do so. So it makes sense. And the US dollar futures curves, which I'm not showing today, the other day I said they were up 30 basis points, from Wednesday to Sunday. Well, since from Monday to today, they're down 30 basis points. They're all over the place. The SOFR versus LIBOR market, the 1 month LIBOR versus SOFR has been sitting at near the zero bound. It even dipped negative for a day. So they're clearly holding ultra short term LIBOR rates. As low as possible. But the 3 month LIBOR is continuing to push towards 50 basis points. So that's telling you, like, the Fed may indeed, they're desperately trying to hold this together, and they don't know what the Fed's going to do at the May meeting. I can tell you what the Fed's going to do. The Fed's going to raise a quarter point. And then the U.S. futures curves are going to go completely nuts. And all of it. The Fed's going to continue to slowly choke the euro-dollar markets until LIBOR goes away. Whether we ever get to 6% or not is irrelevant at this point. Okay. Last thing is the Dow. So here's another is this a false move down, or is this just a dead cat bounce? It's a good question. Where the Dow closes this week, if it closes above the black line, which is these highs in here, and I just took the highest one of these, I took the higher of these two highs here, and so just to give you something to work with. 33,603, 31, that's your level on the Dow. If we get a close above this number, then this will be a false move down. We're back into this trading range and solidly, and we're back into here above the black line as opposed to below the black line. Again, money is going to ground. Gold is at 2030. The Dow is back above 33. Oil's at 85. Money is going to ground. Okay? And for a lot of players, getting into U.S. Treasuries as opposed to everybody else's debt is also money going to ground. It means that Jamie Dimon came out and said, this banking crisis is not over. I didn't note whether Uncle Jamie, which is now a private joke between myself and Dexter, was smiling when he said it. With that, with the Jeremy Clarkson smug face, or not. Probably not. But, you never can tell. Can't be too sure. All right, that's what I have for you this morning. Thank you all for everything. As always, I believe I have by far the best community in the world. And sometimes, I'm going to challenge you, some of you. I do it on purpose, and I do it with nothing but your best interest at heart. And I hope that works for you all. But I can tell you without a doubt that I am every day I get up and I'm just amazed at what we're doing, the feedback that I get, and the quality of the commentary that comes out of the community. It's just unreal. So thank you all for everything. We'll talk on Sunday. Be well. Keep your stick on the ice.